and welcome to the AMI Organics Limited Q4 FY2025 earnings conference call hosted by JM Financial Institutional Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krishnan Parwani. Thank you, and over to you, sir.
Good afternoon, everyone, and thank you for joining us on AMI Organics Q4 and FY25 earnings conference call. Today we have with us AMI Organics management, represented by Mr. Naresh Patel, Chairman and Managing Director, Mr. Abhishek Patel, Vice President Strategy, and Mr. Bhavin Shah, Chief Financial Officer. I would now like to invite Mr. Bhavin Shah to initiate the proceedings. Over to you, sir. Thank you.
Thank you, Krishan. Good afternoon, everyone. We are pleased to welcome you all to our earnings conference call to discuss Q4 and FY25 financials. Please note that a copy of our disclosure is available on the investor section of our website as well as on the stock exchanges. Please do note that anything said on this call which reflects our outlook toward the future or which could be construed as forward-looking statement must be reviewed in conjunction with the risk that the company may face. The conference call is being recorded and the transcript along with the audio of the same will be made available on the website of the company and exchanges. Please note that the audio of conference call is the copyright material of AMI Organics and cannot be copied, rebroadcasted or attributed in press or media without specific and written consent of the company. Now I would like to hand over the floor to our CMD, Mr. Naresh Patel, for his opening statement. Over to you, sir.
Thank you, Bhavin. Good afternoon, everyone. I hope you are all doing well. I will start with a look at the broader industry landscape before diving into our performance for Q4 and FY25. The global economy continues to face significant uncertainty driven by shifting geopolitical dynamics and evolving policy decisions. For the chemical industry, a major factor will be the unfolding U.S. tariff framework. In chemicals, everyone is watching which countries win preferential terms and how China, likely facing higher duties, will react. These developments will drive fluctuations in prices of both raw materials as well as finished goods, setting the stage for highly dynamic chemicals market in 2025. Zooming in on our key industries that we serve, pharmaceutical industry remains our largest revenue contributor. Demand for pharmaceutical intermediates remains stable, and we are witnessing a notable increase in CMO/CDMO inquiries. India is increasingly recognized as a viable alternative to China, a trend our strategically positions to leverage. On the policy front, pharmaceuticals are exempted from U.S. tariffs. However, the U.S. government has initiated investigation into imports of pharmaceuticals and semiconductors, which may lead to future tariff measures. Given the multifaceted nature of these potential outcomes, we will refrain from speculations, but we will continue to watch the developments as we progress through 2025. For battery chemicals, despite moderate demand for electric vehicles globally and delays in new battery cell capacity across the sector, we are observing a positive shift. Manufacturers are actively diversifying supply chains away from China, a movement accelerated by U.S. tariff policies. The transition presents significant opportunities, and we are well prepared to capitalize on this evolving landscape. Moving on the semiconductor industry, while appetite for chips to power the data centers behind the artificial intelligence boom continues to thrive, demand for legacy semiconductors found in cars, industrial equipment, and other devices has been subdued in recent months. Our strategic initiatives in Korea, Japan, and Taiwan are yielding encouraging results, and we are confident this market will play a pivotal role in our future growth. Overall, we remain cautiously optimistic about demand even as a cloud of uncertainty continues to hover over the industry. Coming to AMI Organics performance for the year, I am delighted to report that FY25 marks a landmark year for AMI Organics as we cross the 1,000 crore revenue threshold. This achievement is a testament to the relentless hard work of every single employee at AMI Organics, as well as the steadfast support of our stakeholders, such as our customers, suppliers, shareholders, and all other stakeholders who were part of our journey directly or indirectly. On behalf of the leadership team, I express our deepest appreciation for our stakeholders' contributions to this milestone. As we cross a big milestone in our journey and enter a new phase of growth, the need for a distinct and future-ready brand identity becomes increasingly evident. The identity which honors our enlarged vision to build a diversified specialty chemicals company serving various industries such as pharmaceuticals, semiconductor, battery chemicals, petroleum, agrochemicals, cosmetic and preservatives, as well as reflects our unwavering commitment to serving humanity in sustainable manner. To support this transformation, the management has decided the strategic decision to rename the company from AMI Organics Limited to Ecotas Chemicals Limited. Looking ahead in FY26, we anticipate continued growth in our CDMO business, bolstered by increasing demand and new CDMO contracts. On the generic side, as well as we have several molecules within our core generic intermediates portfolio that are expected to benefit from patent expiration in 2025 and 2026, driving further momentum. Additionally, our electrolyte additives business is scheduled to commence production from new brownfield plant at Jagadia site in the second half of FY26, with other business segments poised for steady advancement. Based on these factors, in FY26, we are confident in delivering 25% revenue growth, a target we have constantly achieved for the past 15 years. To conclude, I reaffirm our commitment to delivering sustainable growth and value for all stakeholders as we navigate the opportunities and challenges ahead. Now, I will hand over the floor to our Vice President of Strategy, Abhishek Patel, for further business updates. Over to you, Abhishek.
Thank you, Naresh Bhai. Good afternoon, everyone. Let me provide further insight into our business performance. Starting with the pharmaceutical intermediates, this segment delivered revenue of 273 crore in Q4 FY25, which is a strong growth of around 44% YOY. For the full year, pharma intermediate business delivered revenue of 854 crore, which is stellar 50% growth YOY. CDMO business was a key growth driver for this business, whereas pharma intermediate business continues steady growth momentum. Moving on specialty chemical business, this segment reported flattish revenue of 36 crore during the quarter. For the full year, the revenue were 153 crore, which is a 2% growth YOY. While the overall business looked flattish for the year, this was purely driven by degrowth in BFC business, which was offset by growth in commodity chemical business. I would like to highlight that commodity chemical business saw strong volume growth of more than 25% during FY25. On a capital expenditure side, CapEx for this financial year stood at 195 crore, primarily allocated to Ankleshwar site, as well as solar and electrolyte additive projects. Let me give you some further updates on the CapEx. Starting with Ankleshwar site, the CapEx work is almost completed, and I believe during the current quarter, we will capitalize the remaining block number 1. On a solar side, I am delighted to share a successful commissioning of 10.8 megawatt solar plant. A newly commissioned solar plant is projected to deliver substantial annual cost savings by meeting most of the electricity requirement of our company's Ankleshwar and Jagadia units in Gujarat. In addition to 10.8 megawatt power plant, we are actively developing another 5 megawatt.
The conference is now being recorded.
This project is expected to complete the near term, which is fulfill electricity need of Sachin unit of Sachin, Gujarat. The capex for the full upcoming year will include spillover capex of electrolyte additive business, along with maintenance capex and new pilot plant facility at Sachin, Surat.
The pilot plant will help us expedite scaling up of new products as well as manufacturing of high-potent chemicals and new products under CRAMS model. Overall CapEx for the upcoming year is expected to be around 200 crore, and we have sufficient cash on hand to fund this CapEx through QIP proceeds and internal accruals of FY25. Before I conclude, I want to reaffirm our confidence in delivering 25% revenue growth in FY26, a milestone we have consistently achieved for past 15 years. On the margin front, we are committed to deliver further improvements in the margin in FY26. I also want to highlight a key trend driven by our business cycle. Q1 typically our weakest quarter, with revenue steadily increasing sequentially till Q4, which is always the strongest quarter. This pattern results in H1 contributing around 40% of the total top line, while H2 accounts for around 60% of the total year revenue. As a result, H1 may appear softer, and this will reflect in our margin with a lower margin in Q1 and Q2 due to lower top line. With that, I will hand over our floor to our CFO, Mr. Bhavin Shah, for his financial update. Over to you, Bhavin bhai.
Thank you, Abhishek bhai. I would like to briefly highlight the key performance metrics for the quarter before we open the floor for questions. I will start with the quarterly performance. Revenue from the operations for the quarter reached to 308.5 crore, representing 37.1% growth and YOY 12.2% QOQ. Gross profit for the quarter was 146 crore, reflecting 62.3% increase compared to the same period last year. The gross margin expanded by 734 basis points YOY and 108 basis points sequentially to 47.3%. Gross margin was driven by better product mix. EBITDA for the quarter was 85 crore, which was almost double when compared to same period last year. EBITDA margins were at 27.5%, up 835 basis points YOY and 257 basis points QOQ. EBITDA margin was driven by expansion in gross margin as well as operating leverage. PAT for the quarter was 62.7 crore, which grew almost 2.5x compared to the PAT of 25.7 crore in Q4 FY24. PAT margin for the quarter were 20.3%, which saw an expansion of 892 basis points YOY and 380 basis points QOQ. Moving to the performance for FY25. Revenue from the operation for FY25 crossed 1,006.9 crore, representing a growth of 40.3% year over year. EBITDA for the FY25 was 232.1 crore, up 80.6% YOY. PAT for FY25 was at 160.4 crore, which was almost double when compared to the adjusted PAT for the same period last year. Moving on to balance sheet item, net cash and cash equivalent were at 249 crore. I am happy to share that even with robust growth, we are able to control our working capital, which was 114 days during FY25 as against 116 days in FY24. This was driven by improved inventory days and stable receivable days. Better working capital management led to strong generation of cash flow from operation of 118 crore, which was around 51% of the EBITDA for the FY25. With that, I request moderator to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudarshan Padmanabhan from Ask ND PMS. Please proceed.
Yeah, thank you for taking my question. Sir, my question is, this year has been very strong on the CDMO side, the pharma side, which has driven the growth. Going forward, I mean, we are very excited about this business. One, on the CDMO side, if you can give some color on, number of products in the late stage which can hit the commercial. And, outside the pharmaceutical side, on the chemicals, because we have a fairly exciting opportunity on the semiconductors.
Hello.
How do we see the scale up there?
Hello, Mr. Sudarshan, sir. Yes.
Yes.
I'm so sorry to interrupt, but can you please speak a bit louder?
Yeah, can you hear me now?
Yes.
Yeah.
Okay.
I would like to understand, the opportunities on the CDMO side, how much of, molecules are there in the late stage, which can go to commercial, and that will drive the growth in the next, in a couple of years. And outside the CDMO side, specifically on the chemical side, we have exciting opportunities on the semiconductor space, with ABA and Chem. How do we see the scale up happening on that side? Because that has not contributed as much as what we would, expect this year.
On a CDMO business side first, as we discussed during last our call also, that we are expecting this business to go up to 1,000 crore by FY28, and the plan is still intact and going well on the track. We discussed during last call also that one of the CDMO projects is scheduled to supply the commercial quantity that is already on track, and other products are also going on track. But it is very difficult for us to share the number of products at this stage. As and when it gets completed, we will update you. On a spec chem business, as we discussed, we are in the process of completing our capex for electrolyte additive production. That is going on track and expected to get completed by H1 FY26. And H2 FY26 onwards, we should have the production facility working, and that will scale up our business or revenue streams from that business also. On a semiconductor business side, the seeding is going on. We are targeting, or we are expanding our reach into newer geography of Taiwan, Korea, and Japan. This is already going well with a new customer onboarding, and it will take its own time because it's a full approval system which goes for some time, and then we can expect revenue starting from those sunrise industry in next coming years.
Sure, sir. And sir, we had talked about, the continuous flow chemistry, gathering good momentum. If you can give some color on, what is the progress there? I mean, not necessarily the number of molecules, but how much have we progressed there, and how much more benefit we can derive from the yield perspective?
So, this question is little technical, so I will tackle this. In continuous flow chemistry, in last four years, we have converted our several chemistry like esterification, trans-esterification, ammoxidation, oxidation, chlorination, photochlorination, diazotization at a very large scale from 10 metric tons to 100 metric tons, and one in photochlorination up to 1,000 metric ton per month capacity we already developed. Some chemistries are already commercially operated, some are under installation right now.
Sure, sir. And I mean, how do we see the progress? I mean, a large part of what we have envisaged has already been implemented, or do we still have a lot more head, way to go here?
These are the chemistries which already implemented.
Sure, sir. I'll join back with you. Thank you.
Thank
Next
you.
question.
Before we take the next question, I would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Rikin Shah from the Boring AMC. Please proceed.
Congratulations on a very strong quarter, sir. My question is pertaining the Ankleshwar unit. So I understand block 1 is being used for marquee customer in CDMO. But for block 2 and 3, have we decided how it would be used? Like, would it be for a specific product, or would it, depend on the multiple products that we have?
So block 3 is dedicated for one of the marquee customer, and block 2 and block 1 will be used for other CDMO as well as other our product as well. So it is not dedicated for anyone. It is a fungible multi-purpose facility.
Okay, sir. And last question on the Baba Fine Chem part. So I understand it's the end use segment is sort of seeing a down cycle, and that's why there is a demand sluggishness very, very evident. So when do you foresee first our Harrier side coming back, and B, addition of more customers, because we are also in the process of maybe getting more approvals done with more customers?
So Harrier business will be revamp for starting from this year. And new customers, we already added 6 to 8 customers this year with the already submitted samples to the various customers in Japan, Korea, and Taiwan. So that will be started ramping up also from next 1 or 2 years. It will be also giving us a good revenue visibility for us in semiconductor. And new samples are already going, new customers already enrolling. We are also in discussion with big semicon manufacturer in this area as well.
All right, sir. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Jason Sorensen, IDBI Capital. Please proceed.
So thank you so much for taking my question, and congrats on a splendid performance in this quarter. Now, sir, just highlighting from a previous participant's question also, CDMO pipeline definitely looks strong for us in terms of darolutamide or on other sales. And I remember that you are not giving any API-specific commentary for confidentiality reasons, so I understand that. So, but just in a directional sense, if possible, could you give some light in how is the pipeline looking in terms of, at least in terms of therapeutic areas? How is the pipeline looking there on that side, especially with a lot of this tariff things coming on China as well? So, how is the demand looking after this whole tariff thing and this uncertainty? So just at least some light in terms of therapeutic areas, if you could give, in terms of the CDMO pipeline.
Therapeutic area is very wide for us. 70 therapeutic area, which is very core therapeutic area for us. But CMO, CDMO, it's not related to therapeutic area. It's more related to your capability and chemistry strength and how you delivered in the molecule in time with all regulatory requirements. So that is a different against the generic segment where the therapeutic area is important to launch in a generic segment. So this is the two difference between the therapeutic area as well as the generic segment. In a CMO, CDMO, we have a strong pipeline, number of molecules I can't disclose over here, but we have a lot of molecules in clinical trials coming, working with several innovators worldwide. And in generic segments, I given my commentary that we have several molecules are coming, launching in 25-26, expiring patent. So they are now picking up very well. And that will be also growth driver for our generic business in upcoming couple of years.
Sure, sir. So block 1 and block 2 in Ankleshwar should be seeing good ramp up in FY26 as well.
Yes.
Okay, sir. And sir, just wanted to know if you could give us the revenue contribution of Baba Fine in revenue and PAT in FY25.
Okay. So, again, what we are looking that we are giving the revenue and contribution of pharmaceutical and specialty. So, so specialty for the FY25 is 15% of total revenue, and overall EBITDA for specialty for the year is 14.7%.
Okay. So you're not giving the numbers for Baba Fine then?
No, we are only disclosing a segment of specialty and pharma only.
Okay. And sir, could you just repeat the margin, sir, for this, for advanced intermediate and specialty chemicals for the whole year?
So advanced intermediate for the whole year is 24.5% and specialty is 14.7%. Average is 23%.
Yeah. So advanced is 24.5% and specialty chemicals is 14.7%, right?
Yes.
Oh, thanks. Thank you so much, sir. And sir, I can understand there is this semiconductor space is a difficult thing to crack. But are we still looking at FY26 being a good year for Baba Fine Chemicals in the growth sense?
Yes.
Okay. And sir, coming to the electrolyte additives business, just some time back we were talking about, now I understand you set up a facility and that's in progress and that will come in H1 FY26. Now, if you could give us some, some numbers in the sense we used to talk about $8 per kg, 200 tons to begin with. Something like that, some numerical sense, would that be possible at this point in time? Or you could give us some revenue indication in terms of electrolyte additives for 26-27?
So for FY26, the start of production facility only, the revenue, the capacity is 2,000 metric ton for VC and 2,000 metric ton for FEC. For initially, it will be a very, very low utilization. And for the revenue number to work out, it will be more or less in the range of the current market price only. We are not expecting any premium pricing which we can expect from this market. It will be on a market driven only.
Market driven only. So, sir, what is the average realization right now in the market, as you can see, for VC or FEC?
So I'm jumping in this question. Answer is that we have dedicated contract for the supply to the dedicated customer. So then we have a formula, and that formula will be implemented for our supply. So that is related to the raw material price. So that price I cannot disclose right now to you, but that is sufficient enough to generate good revenue as well as good margin for us in this segment.
Sure, sir. And so just lastly, wanted to know, you mentioned about the capex for FY26. So you also mentioned three parts to it: spillover capex for Ankleshwar, solar power plant, which we are, I think, increasing or putting up a 5 megawatt more in the solar side, and a Sachin pilot plant. So, sir, could you give the breakup for this? And I just wanted to know more about the Sachin pilot plant. What do you exactly want to do there, and could you give more color on this?
So such a pilot plant at Sachin facility will help us scale up our R&D products because it will be a more.
Okay, I'm just jumping in this answer because it's related to technical as well. So we have our own pilot plant which is going on very well, but being more demand and more product coming into the pipelines and for the scaling up, we need to expand our pilot plant as well to support our large capacity which is we have built up in Ankleshwar as well. So that for that reason we are expanding our pilot plant with the new technology, new facility. Also, we are including one more segment which is high potent chemical segment, which which was not there with us in the past. So that will allow us to have also the CDMO in anti-cancer segment as well. So that is considering all these possibility as well as supporting our expanded capacity in Ankleshwar. We are expanding our pilot plant in that sense.
Okay, sir. And just the spillover capex for Ankleshwar and solar power plant, Sachin pilot plant, how is this capex will come up to 200 crores? Hello? Yeah, I'll join the queue. Thank you.
Thank you.
I will give you the answer.
The next question is from the line of Krishna Chandra Parwani from JM Financial Institutional Securities Limited. Please proceed, sir.
Yeah, sir. Congratulations on a very strong set of numbers. Just two questions from my side. Firstly, I think Abhishek bhai, you highlighted that our EBITDA margin could be soft in FY26, likely due to seasonality. but on a full year basis, will our EBITDA margin be higher than, let's say, 23% reported in FY25?
Definitely, it is going to. That is what, in fact, I highlighted first, and then because of the sequential nature of the business, I drill down to the quarter-wide thing.
Understood. Yeah. So that's clear. Secondly, is there any update that you would like to share on the new CDMO contracts? I think Naresh Bhai in the last call highlighted that the revenue contribution will start in FY26. So how far are we there in terms of the commencement of the revenue contribution?
So we are on track on that. Validation batches are finished, and now it will qualification stage is going on. So we are on track for the time being on that area.
Okay. So will the contribution be more in second half, or when are you expecting? In the first half or in the second half?
Second half.
Second. Understood, sir. Thank you so much for answering my questions. I wish you all the best.
Thank you.
Thank you. The next question is from the line of Dhara from ValueQuest. Please proceed.
Hello. Thank you so much for taking my question. Sir, if I may have missed the margin that you have provided for the pharma intermediate and the specialty chemicals, if you could please repeat.
So, as I already mentioned, that margin for pharma for full year is 24.5% and specialty is 14.7%.
Okay. Other questions are answered. Thank you.
Yeah. Thank you.
Thank you. The next question is from the line of Siddharth Purohit from InvesQ Investment Advisories Private Limited. Please proceed.
Yeah. Thanks, sir. So, if you can give some clarity, what would be the overall market size of the anti-cancer intermediate that we are supplying? And is the market big enough for other players to start supplying to, for the same intermediate that is used for Nubeqa, basically?
We are talking about whole anti-cancer market size.
No, particularly for Nubeqa. That is, what is the market size that is? And there is probably another Indian player who is trying to scale up and the same intermediate. So what is the addressable market for that particular intermediate? And is it big enough for multiple players to supply that intermediate? That's what I want to know.
Nubeqa, we can't say on that because it's not my product, and whatever the data available on the platform, we can help go from there. We are a chemical supplier to our originator API manufacturer, and that market size depends on the contract what we sign. We have full visibility of the contract. There will definitely any originator will not remain with one supplier. They have to supply. So if someone else is already doing in a second supply source, it's fine enough, and we both will be get based on your performance and capability of the supply chain. We will get the business on that if it will be qualified and everything is done.
Okay. So the market size is big enough for multiple players to be present in that segment. That's what I'm trying to understand.
Sir, I can't tell these kind of things publicly as well. I'm bound with so many regulations and contracts. And I don't have any rights to speak about the end user product.
Okay. Fair enough. Thank you, sir. I'll come back in case.
Thank you. The next question is from the line of Josh from Dalal and Broacha. Please proceed.
Sir, if you could mention the CDMO sales for the year.
CDMO sale, we are not disclosing any. We are only disclosing a pharma intermediate and spec chem revenues that we have already discussed because people would like to can derive so many things from that.
Oh, okay, fine. That is my only question. Thank you.
Thank you. The next question is from the line of Jason Soans from IDBI Capital. Please proceed.
Yeah, sir. Thanks for the follow-up again. Just wanted my last question to be answered only. You had mentioned a CapEx of 200 crores for 26, and you mentioned spillover CapEx for Ankleshwar solar power plant and Sachin pilot plant. Just wanted the breakup. And totally how much has been, invested for Ankleshwar? That's all.
So spillover capex is around 130 crore, and remaining would be rest of the capex for maintenance as well as the pilot plant capex for the year. And total capex for the Ankleshwar site unit 2 is 310 crore.
Yes. Okay, sir. Thank you. So basically 130 crores will be done in 26. The rest 70 crores odd for solar power plant and the Sachin pilot plant, right? That should be a fair assumption.
Spillover capex is around 30 crore, which includes the solar as well. And the pilot plant and maintenance in rest of the 70 Rest of the 70 crores.
Rest of the 70 crores. Right. So that's what I said. So 130 crores for Ankleshwar and 70 crores for solar and Sachin, which adds up to 200 crores. Right?
Yes.
Yes, sir.
Right, sir. Okay. That's all from my side. Thank you so much.
Thank you. Before we take the next question, I would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Dikshant Gupta from Geojit PMS. Please proceed.
Sir, so I would like to ask, what are the expected costs from the solar park that you were talking about? Every year, how much can we save?
So you at peak, when the whole 16 megawatt project gets completed, we are expecting benefits of around 16 to 18 crore per annum in the electricity bill.
Okay, and from when can we expect the benefits to?
But 11 megawatt is already completed and 5 megawatt is under construction, expected to get completed soon.
Okay. And regarding the exports business, what is the like? Will we be focusing on exports or will we be focusing on the Indian market?
Both are our focus market. It's a customer and product driven for particular market and particular products we are focused. It's not that we want to focus only certain market. We will follow the diversification policy. Our revenue should not be concentrated to any of the single geography or single part of the world. And both are our focus market.
Okay. And even though the growth on advanced intermediates has been tremendous, but the growth in the specialty segment has been flattish. So is it because of the international geopolitical tensions or have there been other reasons for it?
So as we mentioned, the growth in the spec chem business was compromised because of Baba Fine Chem business for semiconductor for particular customer reason. Otherwise, other spec chem business has grown well, more than 25% volume CAGR.
Okay, and my final question would be, will the debt levels be likely low as it has been in the current year, or will we be looking for debt capex to come?
Sorry, no, we are not taking any debt. Today it is zero, and then going forward also in next 1 year, we are not expecting any debt to be on our balance sheet.
Oh, thank you.
Thank you. The next question is from the line of Akshay from AK Investment. Please proceed.
Hello.
Hi.
Yeah, sir. Sir, my first question is on the capacity utilization. So what has been the capacity utilization at the end of FY25, and what is the peak revenue capability from all our plants?
So capacity utilization unit-wise, unit 1 has a capacity utilization of around 80%. It is almost full, operating almost at a full capacity, and that's the reason for further growth in those products. We are expecting the production to come from unit 2 of next 2 block 2 and 1. At Unit 2, the Block 3, which is already commercialized, is operating around at 50% capacity utilization, and at Unit 3 is operating at around 60% utilization level.
Okay, sir. And my second question is on the front of specialty chemical segment. So, do we expect the better FY26 compared to the FY25 in specialty chemical segment? And if the answer is yes, then you said that we had certain customer specific issues in specialty, in semiconductor segment. So, has it been resolved, or what? Can you give some color on that?
On spec chem business side, our commodity, our products like paraben and salicylic are already growing, which has grown around 25% last year. I expect it to go at almost similar pace in next financial year also. On the other spec chem business, let's say Baba Fine Chem business, there is again slowly picking up, and we are targeting to scale up in next financial year. Also, we have some new customers already coming in, and slowly demand is picking up. And the third stream is electrolyte additive business, which is also starting to produce revenue in H2 FY26. So that's the reason we are expecting even spec chem business also to grow in FY26.
Okay, sir. And lastly, on the FY28 guidance of CDMO revenue of 1,000 crores. So it is the CDMO, and the advanced intermediate would be different. What might be the share of specialty chemicals in FY28 from our guided, as we guided 1,000 crores from CDMO?
Sorry, I didn't get you. We are targeting around 1,000 crore business for CDMO business by FY28, and overall we have already guided that we are going at a 25% CAGR. So that is still intact without any deviation.
Okay. Just wanted to understand that what is the share of CDMO in advanced intermediate space?
No, that we are not discussing, as I just give it to some other participant.
Okay, fair enough, sir. Thank you so much.
Thank you. The next question is from the line of Abhigyan Srivastav from Marcellus Investment Managers. Please proceed.
Hello, sir. Am I audible?
Yes.
Okay. Sir, congratulations on the great set of numbers. I have two questions. My first question is, in the 25% revenue growth that you are projecting for FY26, what is the price assumption that you're taking? Are you taking prevailing prices, or are you considering an improvement in the overall prices?
So we have large business chunk is coming from our advanced pharma intermediate business, wherein CDMO business already assigned and confirmed business with pricing. And as you know that on a regulatory market, most of our business, almost all our business is backed by long-term supply contract only. So that gives us the fair degree of visibility in terms of pricing also. On the domestic side, it is based on the prevailing market condition.
Got it. Thank you, sir. The second question is, currently, what is the price trend that you are seeing in your generic portfolio? Is it stable, or is it going down?
It is growing, actually. The generic business is also growing at a good pace, and we are expecting further growth in FY26 because of some of the products getting offered, and we already started getting good traction in the market.
Sorry, sir. Was this for the prices?
Prices are stable, and raw material prices also stable.
Got it.
Thank you. The next question is from the line of Dhara from ValueQuest. Please proceed.
Thank you for taking my follow-up question. Sir, how much of the 170 crore CapEx that we are doing for the additive project, how much has been incurred so far?
Sorry, Can you repeat the question once again?
The 170 crore CapEx that has been assigned for the additive project, how much of that would be incurred so far?
Yes, around 35, right?
Around 35. And if you can provide the split of the 200 crore CapEx for FY26?
So it is already, I think, 130 crore is for electrolytes, around maintenance CapEx and pilot plant CapEx, both together is 70 crore.
Okay, so additive will be 130 crores in 26.
It should be over of 170 crore.
Okay, got it. Thank you.
Thank you. The next question is from the line of Ajay Surya from Niveshaay. Please proceed.
Congratulations on the performance. So my question is more on the macro side. So if we look currently at the ongoing tariff situation and on the pharma front, USA being aggressive to manufacture themselves, though we are a part of the supply chain, supplying API intermediate, and given our strong guidance, what risks do we foresee, and if you can highlight them across the segments of CDMO, because even our the API intermediate which we sell is being consumed though by the European customers, but the end market for them is again USA, a significant market for them. So what risks do we foresee, and if you can highlight them across segments of CDMO, the API intermediate, and the specialty chemical business?
I will take the first part. The second part will be taken by Abhishek. As I also briefed you during my commentary that there is not any taxation is implemented on pharmaceutical at US side. And if something will come, who will be the better position in that will be helping to grow the business in that. Ami Organic is luckily don't have any direct sales or individual sales in US. We have everything is either in Europe or in Asia or in India. So, and we are also in a supply chain at a bottom level. So impact will also that not great come to us as well. So if there is a percolation, that will be supported with the operating efficiency as well as raw material also have some advantage during that. So we have the different formulas calculated at our end. If it will become, then we will definitely come back to you if there is significant changes in our growth or revenue in the future when if it is a price implemented at US. I'm giving phone to the Abhishek for the answer.
And on the second part of your question related to CDMO business, which is a large contributor for us and goes to US market. So here we are supplying it to the originator, and it's a in-patent product business. So for tariff front, it is more immune to any other business on a tariff side.
Okay, sir. Got it. And sir, another question, because we have seen in the CDMO business of other companies as well that when there is such a ramp up, the innovator generally builds up a lot of prior inventory. So if you can highlight on this front, like whether our shipment or any risk of inventory build up happening by the innovator going forward, which can again lead to a stable or a lesser growth for us in future?
I don't know. They don't discuss all these things.
Okay. And one last question on the, can you please provide the capacity utilization for our specialty chemical business?
It is 60% as it was mentioned.
Okay, sir. Thank you. All the best.
Thank you.
Thank you.
Thank you. Before we take the next question, I would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Maitri Shah from Sapphire Capital. Please proceed.
Hello. Hello.
Yes.
Yeah, good afternoon. Congratulations on a great result. I just have one question. So on the specialty chemicals side, currently our margins are around 14.7%, and we see a ramping up from the semiconductor business, and also from the second half we will see a ramp up from the electrolyte business. So do we see the margins scaling up from here, or they will remain in this range of 14 to 15%?
Margin for spec chem business will be around in this range only, because it's a initial year, and slowly it can ramp up when we scale up the operations.
When do you expect like a margin just like maybe 16 to 17% in the spec chem business, maybe 2 years from now?
So it can happen by let's say Q4 or early next financial year.
By Q4 or next one. So we do expect better margins from the electrolyte and the semiconductor business.
Yes.
Okay. That is it from my side. Thank you.
Thank you. The next question is from the line of Akshay from AK Investment. Please proceed.
Sir, my question has been answered. Thank you.
Thank you. The next question is from the line of Sujit Shah from SK Enterprise. Please proceed.
Hello, am I audible?
Yes.
Congratulations for a good set of numbers. And my question is, what are your revenue and margin target for next 2 to 3 years?
As we already guided, we are targeting revenue growth of around 25%, and margin should improve from here onward only.
Okay. Thanks a lot. Thank you.
Thank you. Before we take the next question, I would like to remind participants that you may press star and 1 to ask questions. The next question is from the line of Sai Kumar from Individual Investment. Please proceed.
Hello. Hi, sir. Congratulations on a great set of numbers. So my question is on the electrolyte salts. So in the past, you said like you were discussing that there were discussion going on for an investment of 300 crores. So I mean, in the past, you had paused it. So any changes or something, any development going on that side?
Status remains the same only as on date also.
So
okay.
the JV what we have formed is still on the same status quo, because till right now there is no movement in that.
Okay. Got it, sir. And regarding the electrolyte additives, so you said like you have some 2,000 metric ton per annum, which is going to get commercialized in the H1. So up to what scale you are going to, what is your growth guidance on that, and what is the scale you are going to take it up to, 4,000 metric ton per annum, or what are your goals on that electrolyte additives?
So it will production will start from S2 FY20, and slowly it will ramp up. So in 3 year time, it should reach at the optimum capacity utilization.
Okay. So okay, that's got it. Yeah, and recently you got PDM, Japan PMBA approval, right? So is there anything you want to give some guidance on, any molecules getting from Japan side? You want to guide us something on that from?
Yeah, so PMBA is a good achievement for us, because now we have 2 manufacturing sites approved by PMBA. So this will help us to promote our intermediates to different customers in Japan. We already having a business in Japan, and with this accreditation, it will be more preferred vendor for Japanese buyers. So it will be definitely help us to grow our business in Japan.
Okay, in the near future, right? Yeah.
Yeah, definitely.
Okay. Yeah, that's all I have, sir. Thank you.
Thank you very much.
Thank you. As there are no further questions, I would now like to hand the conference over to management for closing comments.
Thank you to the JM Financial team for hosting our conference call. We appreciate everyone's question and hope we have addressed most of your queries. If we missed any of your questions, please reach out to our investor relations team, and we will get back to you promptly. Once again, thank you very much, and have a good day and good weekend.